What's up, YouTube fam? Welcome back to the channel. In this episode, we're going to talk about why you should not sell weekly options. Now, obviously, we're having a relatively good day. We're up 2% on the day, about $2,000. But of course, it has to come with some drama. This entire channel has been nothing but drama, nothing but realistically, it's been some smooth sailing moments, right? When we first started this documentation on November 7th, we've been posting basically every day since November 7th, showing the updates of this account. And when we first started, I remember we had a great first month. We were up 25%. Right now, these last couple months have been really nothing but headaches, right? And of course, even a day like today where we're up 2%, it's still coming with its own headaches. So that's going to be the topic of this video, is why you shouldn't sell weekly options. Now, looking back at this position, it doesn't really make sense to have even sold it. I do believe it was partially emotional. We had just closed some covered calls for some great profit, and I wanted to get in another one, what I thought would be another easy play, quick play, and of course, it just completely backfired. Now, looking at the chart, this market has gone nuclear. And I could have seen it coming. Matter of fact, there was a lot of signs that I did see coming and I spoke about in the Discord or even just to my private circles. But ultimately, I let the emotions get to me and I said, you know what? Let me sell another covered call for some quick cash. Now, looking back at it, I don't want to say it was a greedy play, but realistically, it's like you are picking up pennies in front of a steamroller, right? You are, trying to make something happen when there's really nothing to make happen, because if you think about it, 70 cents premium to me should never be a position that you're even selling options on, right? Like 70 bucks for what, right? Obviously now I'm down 830. And when you're an options trader, you do need to ask yourself, is this a good time to buy calls or is this a good time to sell calls? And obviously at the moment, it really was a better time to buy calls. Just looking at the chart, right? We had basically bottomed out. We had bullish momentum, right? It looked like there was signs of a reversal. And ultimately, obviously, today has been just a ridiculously bullish day from probably the moment, right, the market opened. It's just flown up. So now we have ourselves in quite a predicament, right? We're in these covered calls that we sold, and they're up 307% from the day we sold them. And when did we open these positions? Let's see, date sold. So 2 days ago. So from 2 days to today, these covered calls are up 310%. Now, again, looking back at it as an options trader, you need to ask yourself, right? I know I say this all the time on this channel, right? To buy in the money and sell out of the money. But there's always going to be chances where it makes more sense to buy out of the money, because when you think about it, it's so cheap, right? Like in this case, for me to sell, 70 cents. Now the delta was definitely at the 20 range. So, it followed the system in terms of the delta, but the only thing it didn't follow was the fact that the market had clearly bottomed, right? Now, I'm not about timing the market on this channel. So to say, oh, I should have waited for the pump. Yes, it's easy to say that. But again, I thought that, there's a good chance that the market can also continue lower, being that, we are in, or was in, somewhat of a bear market. We kind of still are, right? It's like when you zoom out, obviously on the highest time frames, it is still a bull market. But looking at where we were, I could have easily saw us sweeping these lows. And at that point, I just wanted to, I guess you can say, get greedy. I don't know what the right way to put it is. In the end of the day, we all make mistakes, right? Now, the beautiful part about selling options is the fact that we can roll this position and save it. Now, in this moment, I'm obviously not, I'm not 100% sure I want to roll it this second, but hypothetically, let's just look at the option chain. Let's see what they're offering us, right? It's always like a game of deal or no deal when you're selling options, right? It's like get in the position, sell premium, roll positions. It's like, what do you want to do? Now, earlier this morning when I was looking, it looked like I could have rolled all the way up to 66 for a credit. Now it's at 64.5. So that number is going to keep dwindling. And that is ultimately why, you do want to roll before you get in the money. And that's typically what I like to do. I typically like to roll right before we're in the money. So realistically, what I should have done is rolled as soon as the chart got to like 59 or close to 60. Because for me, I figure like this, right? You always have time. That's the beautiful part about selling options, is that time is always going to be your friend. Time is always in your favor. And when you have time in your favor, it's like you almost always might as well roll before you're in the money, because at least then you'll always be able to roll up and out, right? Because in the end of the day, if you go a month out, it's always going to be at a more expensive premium, right? It's never going to be a cheaper premium a month out unless you went all the way up, right? Like if you go all the way to, $72 where, there's really no premium yet because it's so far out of the money, then yeah, obviously you can't roll and collect a credit. But if you keep your option out of the money, right? So in this case, it's a $60 option. If I would have waited until we were at 59 and then rolled, then I would have been able to get a better deal. I would have been able to get a 66 for a credit for a month. Now in this case, I can only get to, 65, which isn't a big deal, right? I don't mind it. Obviously, if I wanted to go, let's just say hypothetically 2 months out or a month and a half, I can get all the way up to 67. So, that's kind of how the game works, right? Is the more time you're going to give yourself, the higher out you can roll. So in this case, we're on April 2nd. So if I wanted to go a week out, let's see, I could roll right now up into 61 and a half. So, it's something worth considering, right? I like to do that. I don't like to just rush to go so far out. So in this case, I know I was saying I'm contemplating rolling, but I think what I'm going to do is I'm just going to go 2 weeks out and go 62 and a half. So it is annoying because I will take the loss, right? It's always paper losses. At the end of the day, when you roll, right, the only way to turn the position into a complete winner is to then wait for the next position to be completely worthless. So in this case, if I did roll right now, then on my P&L, it would show an $824 loss. But being that I would roll into, let's just say, this premium right here, my entire position would be worth 286 times 4, which is obviously worth more than this. So essentially, when you roll, right, you take the paper $830 loss, but then you're going to be in a position where the position you roll into, right, it's going to be a higher gain. So that's how the credit is formed. So in this case, 286 times by 4, let's just round it and say 3, right, would be 1,200. So it would be a $1,200 win. But of course, you have to subtract this $820 loss. So in this case, right, the credit, and that's what the credit means, right? So if you didn't understand how rolling works, it's really just a simple fact that you're going to collect $12 more than what you're currently at. So it would be $12 more than this, which would essentially make the profit $12 more than this loss, which would essentially offset the loss. So if you roll, you do need to wait for the position you roll into to fully expire to be profitable. Now, obviously, in my case of option selling, I roll for wins, I roll for losses. But as long as you keep rolling out and further, eventually you will get that position that expires, basically completely worthless. That's what led me to this position. I had a position that was up 90% profit. I took it, and then, like I said, I rolled into this. Now, for me, or better yet for you, if you're in my position, right, because the position that I did have that won was a $70 strike. Me personally, looking back, I don't think I would roll into a closer strike the way I did. I went from 70 to 60. That's a lot. That's in terms of capital gains, that's $4,000 because I have 400 shares. And then I also have 2 leaps. So that's $6,000 when you consider all of my shares, right? Because 400 shares and then 2 leaps, that gives you 600 shares worth of buying power. So by me rolling $10 down, that's actually $6,000 that, I kind of just put up for risk that I shouldn't have done. So what I should have done instead, and this is like my piece of advice, is let's just say you sell a covered call for $70, right? And it's like this, where it's basically worthless. Instead of coming so close to the money, what you should do is you should either stay at the strike or stay close and just go further out. So in this case, maybe like a month out, now you're still at the $70 and you're still collecting decent premiums. So that's my word of advice is if you get a covered call and it starts doing really well, maybe one, either just let it expire, right? Because a lot of times you don't know what the market's going to do. You don't know when it's going to bounce. And a lot of times covered calls can bite you in the butt like it is to me. 2, you don't want to start putting yourself at so much of a risk, right? Like I said, I was in a position that was a $70 call. It was about to expire worthless. I closed it and ultimately got into this position, which is now getting beaten up. So, tomorrow and Friday could be bearish, in which, this $60 could actually end up expiring worthless and it could all work out in my favor. But looking at this chart, it's very hard to make a case for that, right? Like when you see such a green candle, it's very easy to think that the next day is going to be a follow through, especially when we've had so much bearishness, right? Like we've just been coming down and down, and we made this bear flag, and then boom, popped down. Now, it does eventually get to that point where the trappers get trapped, right? Like this was clearly a bull trap here, right? We formed this gap. It came down sharp, and now when you look at the chart, it looks as if the bears are going to get trapped. And when the bears get trapped, what happens is it creates a short squeeze, right? So basically all the people that are short, the only way to close it is to buy back the stocks And that's why when things do go down so aggressively, they come back so aggressively, is because all those people who are shorting now start buying back their stocks. And that's what creates these huge moves up. So, just by looking at the TQQQ or the NASDAQ, it's very easy to see that, like, I don't want to sit here and say the bottom is in officially, but the bottom could be in. And if the bottom is in, then these covered calls could be underwater for a while. Obviously, like I said, my goal is to not get assigned on these covered calls. That's like the last thing I want to do. So I'm going to have to decide either today or tomorrow to roll, because if this stock gets to like 63 by tomorrow, then rolling is going to be very difficult. So moving forward, how can I learn from this, right? Because that's what this channel is all about, right? And now looking at this delta, it's a 57. It's crazy because I'm telling you, when I took this position, the delta was, in the 20s, similar to this position right here. You can always tell what your delta was by looking at what the prices are currently. So obviously right now, this is a 70 cents and I sold mine for 70 cents. So it's a 24 delta. So basically this went from 24 delta to 58 delta from the moment I got in the position. And delta is very important to manage, because now this is saying there's a 57% chance this will expire in the money. So from 25 to 57, that's what I've gone through. And now ultimately, as you can see, these options are up so much from when I sold. So listen, it's an uncomfortable position. It's not a fun position. To me, I think the best way to go about it is not to sell weekly covered calls. I think you should focus on selling covered calls further out. Like obviously, when I said, oh, it's not worth selling a 70 cents. Listen, it could be worth selling 70 cents if you're going to go this far out, Like in this case, you'll collect 75 cents, but it's a 16 delta, $72, $12 away. So on my 600 shares of buying power, that's like 8,000 in profit. So even if I did get assigned 30 days from now on these, my account would be up 8,000 more dollars. Now, obviously I get it. That's not the sexiest way to collect premium, but the reality is collecting premium is a very challenging game. It's not as simple as social media makes it seem. In the end of the day, options is difficult no matter which way you put it, right? If you're buying options, it's difficult. If you're selling options, it's difficult. Obviously, in my case, I do a little bit of both. And at the end of the day, that's why if I'm going to sell options, I like to do it against options that I have so much time on, right? Like these two leaps that I own, I have up until 2027. So it allows me to roll months and months and months. If I had these options for 2026, right? If it was January 15th, 2026, it might seem like we have a lot of time since it's only April 2nd. But when you go so deep in the money and you're rolling a month out, 2 months out, 3 months out, a year can go by very, very fast, right? So, it's a great day in the market. Obviously, for me, I'd rather have this problem. I'd rather have this problem of, oh, I have to roll my covered calls out than be getting beaten up. Because at the end of the day, at least I know I'm making gains, right? Worst case, I do get assigned. I'll just go back to selling puts until I do get, my shares back. And that's the other cool part, right? Is like worst case, I do get assigned, then I will be more aggressive with my put selling and probably just start selling in the money puts. Because don't forget, puts actually pay better than calls overall, right? And ultimately, let's just say hypothetically, I did get assigned. I lost these shares on Friday. I can start selling, high up puts to get the most premium. So let's just say on 400 shares, I can start selling this right here and, ultimately make $2,000 in premium, per week until I make all my money back. So getting assigned, running the wheel, it's not the worst thing in the world. And a lot of times rolling, people love to roll. I love to roll. I think rolling covered calls is even better than rolling puts because of the fact that you're getting capital gains as well. But worst case, if I do get assigned, it's like, there's a lot of ways to play it, right? I can go back to selling out of the money puts, or I can try to really make my money back and sell in the money puts. Because even when you sell in the money puts, right, you'll notice how your entry is still better than if you were to just buy. Because look, see how the break even is 57.87? That's because 61 minus this, right? So it's still better than just buying at 60.85. Obviously, the lower you go, the better your entry is. And that's why, for the most part, I do recommend selling out of the money puts. I never really sell in the money puts. But in a case like this, where, I did some stupid stuff and got greedy, that's where I would consider selling in the money puts. And I'd probably sell in the money up until it's higher than my entry. So in this case, obviously 60.85, I'd probably be willing to go all the way up to this one because, again, even if I do get assigned, it's still better than buying at 60.85. So there's a lot of ways to play this game, right? There's no right or wrong way. But one thing I will say is you do need to consider, am I selling pennies to the dollar, right? In my case, I risked thousands and thousands of dollars, right? If we're going to do if we're going to say that I was at a $70 strike because I was on 600 shares, then we're going to say that I risked $6,000 to make $280. Looking back at it, that's a terrible proposition. And, I got blinded, right? I got emotional. That's how this market works. It's very good at taking the money away from people who get emotional, who make decisions like I made. And I'm thankful I made it because at the end of the day, I know I will learn from it. Like I said, if the market doesn't come back below 60 over the next 2 days, then I know I'll roll it and get out. In this case, like I said, I might roll it today just because I don't want to risk getting early assignment, right? That's not something that I'm looking to do. So I might consider rolling it, at some point today just to get, just to create some space for myself, maybe get to like a 66, 67 so that I'm at this high. And then it's just the same thing, right? Let's just say the market does continue climbing and gets to 65, 67. I'll just roll it higher and higher and just keep going based off that. So again, there's a lot of ways to play it. Worst case, I get assigned, I will sell puts again, rerun the wheel. And at the end of the day, that's how this game is. Worst case, you take a paper loss, you just keep making it back. You keep taking positions until you make it back. Obviously, in this case, I started this account with 100K on February 20. It was like February 25th, right? February 21st, something like that, right? Let's look at the deposits. Let's just take that. Let's go to the history. Transfers. So let's just see, when did I put the large amount in? February 25th is when the 70K hit my account to make it a full 100. And look what the market has done. It has literally just gone down, right? So to only be down 12% right now, I'm really not mad about it. A lot of traders would have blown whatever they had in the account during this type of movement. At the end of the day, right, when the market is crashing, there's a very, very small percentage of people that are successfully shorting the market. And truthfully, a lot of those people who are successfully shorting the market are getting crushed a lot more than they want to say, right? So when you're on social media and you're seeing all these people who are successful traders catching tick after tick, the reality is how many of them are full of baloney, right? And even the ones that are legit, they have thousands of people following them that are losing. It's just the reality of this game, right? If everyone was successful trading retail, then retail trading would not exist. The only reason retail trading exists is because the people who are in power are using it as a way to take money from the average person. So don't let that stuff blind you. Sometimes you have to just remind yourself you're doing great. And a lot of times doing great doesn't always mean making money, right? It means saving money. In my case, listen, I have taken some big beats, some big losses. But overall, I'm not too mad because I'm trading volatile instruments, right? I'm trading TQQQ, UPRO. These are leveraged indexes. I'm trading IBIT, which just tracks Bitcoin. Like, these are some of the most volatile assets. Now, people can say, oh, you're down more than the S&P. Yeah, no, I don't want to curse. But guess what? As the market continues to rise and I play this right, I will be up a lot more than the S&P. Listen, I'm not going to go up more than the S&P making stupid mistakes like this, bonehead mistakes, but collecting premium on something like TQQ and IBIT, overall, in my opinion, is one of the best investment strategies. And if you play it right, it will work out really well. In this case, like I said, there's a good chance I do end up rolling it today, maybe just a week or two, and just taking it from there. But, I'm trying to be smarter about it. So, you know what? Let's do it right now, honestly, just so we can get some live trading in for you guys. So let's see. Let's go 0.06. Okay, and let's submit it. And boom, done. So now I just collected a credit, right? The credit to me is irrelevant, right? For me, it's about the fact that I didn't lose any money to now increase $2.50, which on 400 shares is $1,000. So I just saved myself $1,000, right? Because instead of getting assigned at 60, worst case, I get assigned at 62.5. Now, obviously, my expiration is 4/17 instead of 4/4, so it's 2 weeks out. And the credit, whatever, the credit's irrelevant, right? What you need to consider is, assuming this does expire worthless, I will make everything I lost back. So now when you look at my account, you look at my trade history, it will show a $700 loss. But assuming that this does expire worthless, I will make the 700 back plus 300 that I originally wanted to make, right? So that's how the $5 credit works, or whatever the credit is. The credit is irrelevant. What's relevant is now I don't have to worry about getting assigned at 60. Worst case, I get assigned at 62.5. But of course, if we do come knocking on the $62.5 door, then I will, roll up higher. And I still have this other covered call for 61.5, which I'm going to let ride unless we, again, knock on the 61.5 door. So assuming, let's just say, by tomorrow or Friday, we get to $61.40, then I will consider rolling this up and further out. So that's how I manage positions. Now you just saw some live trading firsthand. This other position that I'm going to want to consider rolling is this UPRO, which is also in the money. So let's just give it a whirl and let's see what we can do. So we're at 76. I guess the expiration was for what, the 11th, was it? Yep. So we're going to go out to the 17th and let's see how far we can get up. So in this case, we would only be able to get up basically 10 cents or not even, right? We wouldn't even be able to move if we went a week. So what we're going to do is we're going to go 2 weeks out from it and let's see where we can go. So this doesn't look right. So sometimes when you trade these low volume instruments, right, it's hard to really wrap your head around these premiums because they don't really make sense. As you can see, it goes from 450 to 338. So maybe we're gonna go all the way out to May 2nd. And even May 2nd, it's not really adding up. So in this case, in terms of how I want to roll this, I think what I'm gonna do is I'm just gonna go 1 week up and I'm gonna go to 76.50. Let's see, it says medium fill. So we're going to go to 10 cents to make it a high fill. And we're going to get in there. Let's see. And we rolled out. So there you have it. You know, my two covered calls that were deep in the money are now out of the money. We have UPRO 76.5, TQQ 62.5. Now the UPRO, we have 2 years on this leap. It's up $100. Again, this is how you trade. This is how I trade, right? I look to buy these leaps, sell covered calls, and if the worst case, these covered calls go deep in the money, just keep rolling. Best case scenario, obviously, is this leap ends up being up while I have all that covered call income. Now, obviously, as you see, today's return is jumping. It went from 100 to 300. It's because the spread is so crazy on this, so it doesn't actually represent accurate P&Ls. In the end of the day, until I close the position, this is all irrelevant. Obviously, yes, we are down because we got in at the top on our first entry. We opened up our second entry a week or two ago. So we have a lot to look forward to with this position. I do believe that this leap in 2027 will be very successful. Obviously, it is on a leveraged instrument, but it's a leveraged instrument that follows the TQQ. It follows the NASDAQ, which in the end of the day, when you look at the NASDAQ, over the long term, of course, it really just only goes up. And of course, from the moment we rolled this position, now when you look at this chart, it's falling. But you can't ignore the fact that it's a bull trend, even with these red candles. Right? These are small time frames. These are just pullbacks to shake out the people who are highly leveraged. The reality is, you know, listen, this could be the supply that holds and we head back down. And the cool part about rolling these covered calls is it doesn't really matter, right? Like, yes, okay, if I didn't roll, then obviously the original position, you know, would have expired worthless. But look at this. The one that I rolled into is already up 88 bucks. So assuming the market did crash back, right, this position that I rolled into would become worthless maybe a little bit slower, right, than the one that expires on Friday. So that's the thing about rolling. There's really not much downside, especially if you don't roll too far out. Like I only rolled 2 weeks out, which in the world of options, you know, that's the thing that really opened my mind was the fact that like this option is 2 years out and it's down 40%. So it just goes to show even 1 week, 2 weeks, a month, 2 months, these options could still go down 50, 60, 70, 80%. So it's like, why would you sell weekly when you could sell, you know, a month away and ultimately still go down 60, 70%? And guess what? If you're down 70% on 1,000, that's a lot more than being 100% on 400, right? So, you know, there's a lot to consider in this world of selling options. I hope you learned a little bit about how this game works from my video. Obviously, I'm still happy about today. We're up 1.6%. In the end of the day, I would rather have more days like this, right? I'd rather the market continue to go up and me have to roll my covered calls than have another month of just this. So, and just to wrap up this video, that's why I've been sticking to TQQ. Obviously, something like TSLL is now ripping, which, you know, I did mess up on my position with this. I did kind of close out at the bottom because to me, I just don't love trading individual stocks. I don't love trying to guess. I don't love dealing with the news and the risks. To me, I find more risk in these individual stocks than I do trading something like TQQ because even though TQQ is a leveraged asset, these individual stocks, it's like, you know, you don't know what they're leveraging behind the scenes. You don't know what's going on behind the scenes. You don't know when you're going to be in the stock that doesn't go up while the rest of the market soars, right? Obviously, in a day like today, Bob was down 2% while the rest of the market's going up. And a lot of these stocks do that, right? Yes, a lot of these stocks will go up more than the NASDAQ, but at the same time, for me, I don't think it's worth trying to guess which stock is going to be profitable. I'd rather just stick to things like TQQQ, like IBIT, and just continue to profit off those positions. So I hope you feel like you got a lot out of this video. I hope you feel like you learned. Make sure to like, make sure to comment, make sure to subscribe, and I will see you in the next one.